Okay, so I will talk about data analytics in finance and mainly focus on the challenges and the opportunities, but I will also discuss some projects and ways we have used data analytics in finance and current ongoing projects. Some of the work has been published, some of the work is still in form of working papers, but nevertheless, the interest in finance for me is not only because I started in this field in the industry and then came to academia, but I felt at the time that if something happens in the financial world, so to speak, that this affects a lot of people. Because it's not an isolated industry, it's not some remote place on the planet, but it's really something that touches everybody's lives. And we saw that, all of us, in the most recent financial crisis of 2008. I don't know of a person who has not been affected by that crisis or who has not been aware that it was going on. So we looked into lots of data after the fact, so to speak. And it was after the fact because even the people who are supposed to have access to all the data, to the reports of the banks, to the publicly available information, did not really have the tools to absorb all that data and to properly analyze it, or even more so, to create some sort of real-time monitoring tool, which is where the idea to focus in this field also mainly comes from. Because sometimes what happens in academia is we do have a project, we finish it, and it's on data between 2000 and 2005, and then the model is done, the data is done, the paper is published, and then we move on to another project. So how about taking that analysis or model and adding the new data and making it dynamic and see how the models should change to capture the dynamics in the development of the economy, the financial world. So I'm going to just briefly tell you some of the motivations that brought us here, but it is very known, we're all aware that the economic systems are related, and we live in a global village, and there are no borders, so to speak, to investments, to traveling, to internet, unless it doesn't work. So certain features of the system, though, are very vulnerable, and because of the interconnectivity of the system in economics and finance, if some shock happens to any part of the world or any part of the system, it's very easy to propagate to a different country, to a different market, to a different environment. So these shocks can be exogenous, like the 9/11. Nobody could expect that. And it happened. It affected greatly, negatively, adversely the financial markets. Very short time after, the markets recovered. But when you look at the subprime effect, the endogenous shock in the financial markets of more recent years, it was very much prolonged, and we're still really suffering from its effect. So what happened in the subprime mortgage crisis is really not completely clear even to these days. But what is clear is that had the regulators, the policymakers, the central bankers, had the proper tools to analyze the data that was available on documents on mortgages given out, on different characteristics of the borrowers, on different backgrounds of the borrowers, neighborhoods, and had they had real-time dynamic tool to gather the information, to analyze it, to visualize it, and to monitor the state of the system, probably the crisis would not have been as grave as it was. And I'm saying this because there were people on Wall Street actually who did have these tools, their few hedge funds, and there are few people who realized what's going on back in 2005. So just one piece of information. In 2005, approximately most of the subprime mortgage loans were in the form of fixed rate for 2 years that will adjust to a floating, much higher rate after 2 years. Well, it doesn't take too much to realize that starting in 2007, there is a high probability that the subprime borrowers would not be able to adjust to these new rates. So lots of people took this under consideration, took advantage of it, did the analytics, and started purchasing something called credit default swaps. But I'm not going to go into that right now. So basically, the data is important to realize the state of the system, the dynamics of the system, and hopefully the predictability of the system. So we looked at all these aspects. And if you talk about the financial system, where the crisis starts or where the risks lie is in a formation, if I can put it in one word, of some sort of a bubble. So a certain asset starts increasing in value. It's very attractive. It's the American dream, purchasing a house. It's the tulips in Netherlands, beautiful. Everybody starts purchasing them. The price rises up to astronomical levels, and it's not sustainable. So looking into formation of bubbles is not that big of a deal. We could detect formation of bubbles. The main issue is we don't know when they're going to burst. And so everybody wants to ride the fast train, right, while it's going on. So besides all the other bubble formations that I have here, probably most of us remember the dot-com bubble from the 2000s. We all wanted to invest in high-tech companies. You didn't want to be left out. They didn't have cash on the balance sheet, on their financial statements, but who cared? The prices were going up. So little more thorough data analysis of financial statements would have probably stopped many investors from doing that. The United States housing bubble essentially ultimately created the European sovereign debt crisis as the governments started saving the banks. So data analytics in finance sort of comes natural. I don't think it's a new field. I think it's not well explored field. I think it needs to be much more developed and brought to a different level. But if you just look at this chart, I put it there so that without even knowing what's on it, I think everybody's eye will stop on that black line. Well, this is the market capitalization as a percentage of GDP of the exchange-listed companies for European Union candidates. And that black line is Iceland. So again, a mathematician, anybody with a quantitative background will start looking at the derivative or that slope of the line changing and becoming steeper and steeper, and probably would have become concerned. But sometimes I think people, even besides seeing formation of bubbles, they're sort of really prone to ignore them. So I think real-time dynamics, modeling and monitoring and signaling mechanisms are necessary to get out of that habit and really do something about it. Preventatively, it's like a vaccine, not waiting for the flu to break out and then everybody gets homesick. So there are also background reasons why this happened in Iceland, why the banking system collapsed. Well, in 2001, the banks became deregulated. Then the 3 banks held about 50 billion euro of foreign debt, and Iceland's GDP is 8.5 billion. Again, not a sustainable situation. In 2007, the economists ranked the Icelandic krona as the most overvalued currency, and this was a serious political and economic crisis in Iceland, and by the size of the country, it's the largest suffered by any country in the economic history, the largest crisis and in political, social, and financial sense. So Iceland is such a remote island somewhere in the north. Why do we care so much about it? Because of this interconnectivity. So what I try to emphasize and try to bring up more in my talk here is that we do not live in an isolated village. Even if it's Iceland and it's far away and it's a very tiny country, we need to care for it because lots of depositors in the Icelandic banks were not Icelanders. They were foreigners. And these foreigners belong to their economies. And these greater economies are related to others. And there is no need to tell how international and how global financial institutions are these days. It's very difficult to grasp their complexity. And often when we were talking about lots of buzzwords like too big to fail, it really became the follow-up buzzword, too big to manage. And then the talk about breaking up financial institutions came to be popular. So the systemic risk, in a way, is what I think needs big data analytics. Because it's not one type of data, it's not one way organized data, just like we heard before. Their data comes in so many different ways and different formats that it's very tasking work to first really bring it to the point when it can be well analyzed and understood and used ultimately. So looking into banking system, then the unemployment, and then all the social consequences, and then the housing market. So it came to be a global financial crisis transforming itself in the sovereign debt crisis that then Europe had to grapple with for a long time. So to give you an idea of some of the data sets that we have used for example, we used in our analysis the commercial bank balance sheet data of the United States banks, which really gives us all the assets, the liabilities, the equity, and all the ratios, the characteristics of the financial institutions in our financial system. So why did we do that? Well, because we noticed, even at first sight, that the banks that failed in the 2008 financial crisis were very different from the banks that survived. So that was a clue. And if we could now have this monitoring of the different characteristics of the banks and see which ones are stronger and more robust, the point is to make the others conform to this kind of stability and type or characteristics of their financial statements. We also used the US failed bank list from the Federal Deposit Insurance Corporation. And this is publicly available database. FDIC is publishing it on the web. Every day when a bank fails, you can see the bank name, the date where it fails, and whether it was acquired by somebody or it was extinguished. We looked into the largest institutional holders of something called gypsy sovereign debt, which includes the troubled European countries like Greece, Ireland, Portugal, Spain, and Italy, and modeled the distress propagation through the institutional network based on value reduction in these sovereign debts, which actually happened in reality. And then we looked into different pricing data from Bloomberg, such as foreign exchange rates, global financial market indices, or great default swaps. And last but not least, we also have Thomson Reuters news sentiment data, which was also mentioned in the previous talk, the importance of machine learning, text mining, and finding the relationship or the influence of news on financial markets or financial markets driving news contemporaneously or causally. And so this was interesting to look at. So just to give you an idea of the size of the data, we analyzed in the first data set approximately 7,000 banks and picked 13 relevant assets for 30 years. So that's about 2.7 million data points. So the other set, the FDIC list, was just 500. There were 500 banks on the list. It's small. Is it important? It is. So the data set of the institutional holdings also had about 500 data points. The Bloomberg data, the financial market pricing data, had about 200,000 data points to analyze. And then the Thomson Reuters daily indicators, sentiment indicators for countries, amounted to something close to 17 million data points. And we also have the intraday, 24-hour, minutely rolling sentiment data, which amounted to something like 25 billion data points. And we realized we are not even close to the sovereign debt outstanding of the United States of America. Anybody knows how much is it? It's a bonus question for the end. So big financial risks have started mushrooming in the system from many different areas, and this is why we needed different type of data and different sizes of the data sets to look at them. So basically, in the banking financial statement analysis data, this is the first thing that really struck me. I don't know if it strikes you. But between 2000 and 2007, 27 banks failed in the United States of America. And between 2008 and 2013, there were 470 banks that failed. So this was already a pretty good data set to test our model against, to see which assets were the culprits, the concentration in which area were the culprits of this mortgage or banking financial crisis. And this is the failure of the banks per state, with Georgia, Florida, and Illinois leading. And you cannot see Massachusetts because it's somewhere towards the end, which is where we are. So in the financial institution network, we created bipartite network, and we analyzed the interrelationships between the assets on the balance sheets of the banks and the banks themselves, their health. So what happened is, as we looked into certain asset and we reduced the value in the model, the risk was propagating and making certain banks to fail, and certain banks survived this systemic risk propagation. So the banks that survived had different characteristics from the banks that failed in sense of the concentration of certain assets on their balance sheets. So if you look at the loans for construction and land development, the red is the failed banks, you see that there are many more with higher concentration in these assets compared to the all banks. So I'm going to stick with that asset for a while and talk only about that because I wanted to tell you something more about some other exciting uses of the data, the other type of data. But if you also look at the leverage ratios, the failed banks were much more leveraged than the banks that survived. In other words, these banks had so much liability on their balance sheets, they had to pay somebody else to that extent that any reduction in their asset or capability to pay their debts was going to wipe them out. So we did certain simulations, and we figured out that for that particular one asset, loans for construction and land development, when we damaged the value of that asset, there was a clear separation between the failed bank's survivorship rate, which is the red lines, and the blue lines. So naturally, we wanted to further look into that asset. And then we had the model identify which banks are going to fail if that asset is greatly damaged, which is a loan for construction and land development, and the predictability of what our model identified compared to the real list of the Federal Deposit Insurance Corporation was matching in a very significant way. So the area under the curve here was pretty large for that particular asset. And then looking into other assets that we analyzed, you notice that for agricultural loans, for example, there is no predictability whatsoever. the agricultural loans were not defaulting and were not, in general, dangerous for bank failures. So that was an interesting finding, and it turned out that this was also interesting. So other countries, colleagues from other countries, from Latin America, from Europe, from Japan, started doing similar analysis, and we were finding similar results of the types of assets in different countries. So when we looked at the investor institution data, we realized that if you look at this chart, for example, the sovereign debt of many countries after about 2008 has an upward trend. Now, on purpose, I just stopped at 2010. Okay, so we know what's going on in 11, 12, 13. And it's just interesting to see that not only the troubled countries, but the countries that are not troubled or considered solid have a very upward trend in amassing sovereign debt on the government balance sheets. So this is something that's unsustainable too. So next step for us will be just not analyzing the troubled European gypsy countries, but analyzing the entire sovereign debt holdings on big institutions around the world and see what the model will tell us, which one is the most dangerous. So the sovereign debt crisis in Greece and Ireland is pretty tiny again. Like I mentioned with Iceland, these are not big countries. Collectively, the Greek and the Irish GDP, smaller than the GDP of Pennsylvania. So why do we worry so much about it again? We need a different look into the data, and we need a network type of look, topology type of look, connectivity type of look into the data, and analyze it in a very different way from the originally or traditional economic point of view. So there were many changes based on this financial crisis and the European sovereign debt crisis in sense of regulations, certain increased reserve requirements for the banks, the central banks saving some of the institutions. But ultimately, this is again a static measure. We know the data. The banking authority, European Banking Authority, will do the stress tests, and then it's done. And then wait a certain period of time, and then do the stress tests again. So the point that I'm trying to make is we have the data, and we have the macroeconomic data, we have the data analytics tools, we have the technology, so we need to use it to create more real-time and dynamic type of tools based on data analytics. So the sovereign debt of these countries had different characteristics. Italy and Spain are large. Italy is the largest by all means. And given that most Italian banks hold Italian sovereign debt, you see, for example, one bank, Intesa San Paolo, held 80 billion euro of sovereign debt. Just one bank. And this is after the European Banking Authority had demanded that they reduce the exposure to sovereign debt. So the Italian and Spanish debt dominate, followed by others. So there are different types of charts that we can create and see what's going on. But the idea is to go beyond that, to use the technology power and the data analytics to really create a better monitoring tools. So we look at the distributions, we looked at the holdings in these different debts. We created a model for stress propagation. And again, we found some pretty interesting results. There were certain communities that were being formed of banks that are stable and banks that are vulnerable. So if we could see it, probably the regulators could use that and see it as well and say, well, look, maybe we should keep a closer eye on these vulnerable banks because they may become a problem. Mm-hmm. So the connectivities of financial systems are also not only in the banking system, but across financial markets. So we looked in the distress propagation model for different types of networks, mainly foreign exchange, stock markets, etc. And again, you look at certain correlations, you look at dependencies, and you see some clustering of interdependencies, and the markets start behaving in a more similar fashion. It's an alert sign. This is a result of a distress propagation model, and how long does it take for one market to affect all the others, for different markets, for foreign exchange and for stock market, and the credit default swaps market. Now, what's interesting also is if you look at the stock market, even though we see the mean of the correlations increasing, there is also increase in the standard deviation. But if you look at the credit default swaps, while the mean was increasing in the crisis years, the standard deviation was flat. So it all went in the same direction, which shows higher risk in the system. And let me just give you a brief overview of what we did with the financial data. But this is a minimum spanning tree of financial markets, which are the red nodes, and news for these same markets, which are the blue nodes. And immediately you can see that the red nodes are like the highway, and the blue ones are the roads, the side roads. So this really means that the financial markets are the backbone of the financial news and market network, and they are affecting it. And there are many more important financial markets than financial news sources, so to speak, if you want to look at the effect on other, or the spillover effect to other markets. These are some lagged correlations, and again, in the news universe, there are not that many. It's a day lag, and then when you come to markets to news, the lag correlations become more dense, and then markets to markets, they really affect each other. So we did detect also certain communities of markets that could be predicted by a community of other markets, which is also pretty useful in today's financial world. So let me just quickly close with the challenges and the opportunities. But basically, we still have the same challenges as before with the smaller data, or not so much emphasis on analytics. We still, besides finding statistical significance in our results, need to find economic significance. And without this thorough analysis, we're running a risk of having a signal-to-noise ratio coming to zero. So what's needed is better answers, not merely more data, and predictions to be made in dynamic, not a static world. Now, the opportunities, I start with big data has arrived, but big insights have not. And I do see this as opportunity because we have a lot to do, lots of work to do to come to those big insights. Moving from static to dynamic data analysis, performing data analysis in real time, and really ultimately helping regulators to get used to this real-time monitoring instead of annual or triennial stress test results. The new approaches, such as network science, complex system theory, and last but not least, visualization. Very convincing visualization to understand and to really see what's in the data. So I just wanted to bring this up because John Leichty from Penn State University said financial markets are at least as complicated and important as the weather, but we don't have the equivalent of National Weather Service or National Hurricane Center for financial markets. And he's right. And then Hal Varian of Google said to make money, you've got to predict two things: what's going to happen and what people think is going to happen. So opinions matter more. And finally, big data can help in improving modern society, can be helpful for bringing together different disciplines and also different areas like academics, financial industry, and regulators together to tackle the problem. The challenges for the governments and regulators, as I mentioned before, was that they did not have the right tools in 2008, but the big data can assist policymakers by offering the possibilities for creating this dynamic monitoring systems. And thank you very much.